Hello, everyone, and welcome to BFW 2401. Today, we are talking about pre-class activity number 3, which deals with the topic of week 6. Topic of week 6 is liquidity and liability management. Now, let's start first by stating the fact that as long as we are managing this financial intermediation and we are financial institution or depository taking institution, then in this case, we are subject to liquidity risk. But what is this liquidity risk? Liquidity risk started with the management of the liquidity and any flows that can happen during that management of that liquidity. And the second thing is actually managing any what we call liquidity stress. And liquidity stress is when the withdrawals of the customers is more than the cash coming, which means the deposits leaving the bank is more than the deposits coming to the bank. Now, banks have already taken into consideration this, and they have what we call liquidity buffer. That liquidity buffer in most banks in Australia and in this country, prudentially, is between 7 to 8%. But the problem is, we can have more than that. We can go to 50%, 20%, which we call it liquidity stress. And we can test this under what we call different scenarios when we are planning liquidity. If this is happening, then the bank usually will seek to, as we talked in the class, we would address that liquidity problem by either selling its asset under what we call stored liquidity. They can sell their holdings of those assets, or they can actually borrow from the interbank or from the central bank, or even from the market under what you call purchased liquidity. Now, what is the liquidity buffer? The liquidity buffer is actually either cash, when we say this is our liquidity buffer, which is the 8 to 10% I just talked to you about. It's either cash or securities that can be converted to cash very fast. And this mostly are government securities, AAA ranking, everything is secure about them. Now, if we understand that issue, we will move to something called the bank run. And the bank run, I talked about it in the class, and it is actually talked about it in the slides and also in the recording. And it is, just take it like this, it is the extreme risk of liquidity for any bank when it comes to insolvency. Now, this is actually a nightmare for any banker, because if you go to bank run, that bank run in few days will take you to insolvency or to the collapse, or the regulatory authorities will come, regulators will come and seize the bank. Now, having understood those, what would happen if there is a bank run? You can deal with it too somehow. The central bank can support you by buying your securities, and they can open window for that. If you are too big to fail, then they can bail you out. Now, having seen all of this, let me take you back to the history of those, because this is how I built this case. I built it, I studied 3 extreme cases in 100 years, last century. I started with the Bank of the US, 1930. That was the first bank run. And in that video, it will show you how the bank run happens and what is the causes of that and how can it accelerate. Now, of course, after 1930, so many regulations come to the picture, and we used to have some bank run here and there. We have it in this country for one of the banks. We have it in Boma, Bank of Victoria in Australia, and we can have, between some time and the others. But when there is a huge ones, like what happened during the financial crisis, then it can has a ripple effect. So in 2008, I brought you the next case, which is in 2008. 2008 is talking about the Northern Rock. Now, Northern Rock is a huge bank in the UK, and suddenly, because of some shortage in cash, the bank run happens. And when the bank run happens, Bank of England also, which is the central bank of the UK, was trying to help and promised the customer that they will help. But end of the day, because of the huge queue up, the bank was collapsed. Now, the third one, which we have happened just 2 weeks ago, which is the Silicon Valley Bank, and then followed by Signature Bank, which is happening just, it happens on the 10th of March, actually 30 days exactly from now. But before I go to that, which is the third case, which is the main discussion in our pre-class activity, let me tell you what is a bank run and why it happens. Bank run happens, as I told you, not because the customer wants their money, but because there is a panic. And if this bank run happens in one bank and the regulators didn't move and there is no solution, there will be a ripple effect, which means there will be a bank run in every other bank and in every other country. And if this is happening, it will just a ripple effect and domino effect, like everything will collapse. This is what happened during the financial crisis. So regulators are very careful to solve the problems when it starts, not to hold the bank, but actually to help the system. Now, the other fact about the bank run is that the problem is our contract to the bank. As a depositors, depositors who deposit their money under saving account or current account or even checking accounts, when you sign the contract of that deposit, in that contract, it tells you if there is a collapse or a bank run, the bank will start distributing its asset or cash under the basis of first come, first served, which means if I have money in the bank and I don't need it, but I hear some rumors that the bank is going to have some difficulties or it may collapse, what I will do, like any other person will do, will run first. And will run first means I will go and queue up and take my money in the same moment. So the whole population of the depositors can queue up in front of the bank in 2 hours or 3 hours. When we say 2 hours or 3 hours, it can happen. You can queue up online through your internet banking, or you can queue up in your what we call phone apps, those smartphone apps which give you access to your account, or you can do physical queue up, which is in the bank. Now, the problem is if the bank, this is how the bank run happens. The bank will start distribute or transfer or accept the withdrawals of all the customers who come to withdraw their money until the money is finished. So you can receive 100% of your money, then the person next to you queuing online or physical will receive zero. This is the problem. So to avoid this, everybody wants to run first. And this is why in few moments, in few hours, you can see a bank who has a withdrawal of 15% of the or 20% of the customers, and just 1 hour time, whatever, you will find this to be 80 or 90% of the customers. Now, the government, the regulation, especially after the financial crisis, has come with something called deposit insurance scheme. Deposit insurance scheme started in the US. And the deposit insurance scheme says, if you have up to 150,000 and there is a bank run, then the government or the insurance party will give you your money back. This is a regulation spread all over the world, or all over those advanced countries and developing countries. We have it in Malaysia, 250,000 ringgits. We have it in Australia, 250,000 Aussie. We have it in the US, 250,000. Now, having said that, they will pay you up to 150. And the reason behind that is they want you not to run. They won't stop run, they bank run, they won't stop the panic. But the problem also, if banks know that their customer is insured, they will not be careful and prudential in their management, and they will start to take more risk, because more risk will give them more return, and they know that if there is a problem, the insurance will pay, or the government will consider them too big to fail, and they will come and to help them by this bailing out using the taxpayers' money. Having said that, let me now bring you to the third case, which is our case, which is the Silicon Valley Bank. Just allow me to give you some facts about this Silicon Valley Bank. You will read everything about it. This Silicon Valley Bank is not a huge bank, which means it's not under this class of too big to fail. So the bank has around $212 billion of assets. Now, this bank actually serves one category of customers, or mostly, which is the high-tech industries, and most of them are startups. Now, the other issue about this bank is they invest all their money in bonds, in government bonds, and which is secure, but actually they don't have that diversification. During the last 2 months, as you know, because of this inflation hiking in the US, they increased the interest rate. When they increased the interest rates, all this holding of Silicon Valley Bank actually dropped, because the price of any bond, as you see, the cash flow over the interest, if the interest goes up, the price of your asset will go down. And this is why the bond go down. The other problem with this bank was most of their customers, also they are startups, but they have more than 250,000 dollars in their accounts, and therefore actually they are not subject to the what you call they lose this advantage of deposit insurance scheme. So most of those customers like this. The other issue is also was the problem of the slowdown, the slow and the sluggish economy with this high tech during the last 2-3 years. So they started to withdraw their money. So actually, also the money with their money with what you call SVB, which is the Silicon Valley, but Silicon Valley didn't actually give these customers loans that they need, but they received their deposits. So of course, to keep the payroll and to keep the operations, those companies started to withdraw from their accounts. Now that bring the bank to a little bit of liquidity stress, but not a bank run. Liquidity stress, which means the withdrawal were higher actually than the deposit additions was less than the deposit withdrawals, or money leaving the bank is higher than the money coming to the bank. Now the bank, based on that, they started to deal with what? As we learned, they started to deal with purchased stored liquidity, which means they started to sell their assets. And what is their assets? Those bonds. Now the bonds prices is dropping because of the interest rate risk, and so they are making losses. That actually was the trigger where customers started to worry that if this is going to continue, it looks like the bank is going to collapse. So those companies who actually did not need to withdraw their money, they started to withdraw. And just on the 10th of, the problem started to accelerate on the 8th of March, just 1 month ago, a few weeks ago. And in the 10th of March, there was, in that day specifically, there was around 42 billion ringgit of withdrawals. Just imagine a bank with over 200 million dollars of assets, and you find $42 billion actually withdrawn in one day. Then that was Friday, and with the weekends comes, the regulators come and seize the bank and take it over and consider that banks to be too big to fail. And actually they stopped the ripple effect. And the government was obligated and promised, even President Bush talked about it, promised to give the customers, the depositors, their money back, whether they are under 250,000 or over 250,000. They didn't do anything for the shareholders or for the bond holders. Now, this is the whole story. So you have a story of 3 consecutive cases through the last 200 years, and this will actually reflect what we are doing. Now, let me tell you about the activity. The activity is 5 questions. 4 of them are just very straightforward. You can look at the videos. Some of them about, Bank of the US. Some of them is just a simple issues. But then the 5th question is, which is the core of the activity as usual. I want your feedback, please. What do you mean by feedback? Look, when you look at this Silicon Valley Bank, we have a regulation in place, and these regulations has been updated after the financial crisis and before, and they keep updating it. We have active supervisors around all the world, and the Federal Reserve, for example, in the US, and FDIC, and all those people actually, and the Treasury in the US, all of them are actually watching. And then you have tools like deposit insurance. Still, we still have the problem. Still, bank run is happening, which means none of those is, if you say, okay, earlier this century, when the Bank of the US in 1930 was collapsed, we didn't have all those tools. We didn't have proper regulations in place. When Northern Rock comes, we didn't have actually, deposit insurance for everyone. Maybe there was loopholes in the regulations. But now we are talking about 2023, and this problem is happening. So I want you to tell me what is the issue and how can we solve that. I'm not asking for magic. I just want to say you do some readings and they give you some solution. Is it the management? Is it the regulation? Is it the nature of this financial intermediation? Is it the diversification of the banking of the total asset? Is it recklessness of the management? They are not really prudential in a way that they deal with that bank or manage that bank. So I want you, or is it the regulators didn't take action and proper actions when the management was, misbehaving and misusing those funds in their policies? So all of those issues actually are subject to have your output. You need to do some actually readings. And the question is actually about the Silicon Valley Bank. Please do some readings. Please write it in academic way. As I told you, you have to bring the citation and you have to bring the list. You will write up to 230 words, 200 words. Because this week is a break, I give you, I want to finish the tutorial next week, and then you submit. By the end of next week, we have the exam, and I want you actually to do it after that. So I will give you until the 23rd of April. By the 23rd of April, please do it. And in this case, we can actually, that will be Sunday. You can look at it today, I mean, during this week if you have free time, but we are not supposed to give you any assignments during this semester break. No, by this, I wish you the best, and I hope you do a good job in this one. And I want you really to enjoy the process and deal with it as a story. And it's a very good test. I spent a long time, trying to build this case, and I did. Hopefully, you like it, and I will be looking forward for your very positive and constructive feedback. Thank you. Bye-bye.